Welcome back, focused learners, to another explainer. So it's July 21st, 2026, and if you've been watching the global markets even a little bit lately, you know we're right in the middle of a highly volatile storm. Right now, escalating geopolitical tensions in the Middle East, specifically the intensifying situation between the US and Iran, are sending massive shockwaves all across the globe. Today, we're going to dive into the hard data to understand exactly how this geopolitical earthquake is reshaping everything, from big tech stocks to the price of oil and even your digital assets. We're going to break this all down logically and efficiently so you can really understand the mechanics driving today's market reality. Let's get into it.
Here is our roadmap for today. We're going to start with a global macro picture, then track its impact across 4 areas: pressure on equities, forex hotspots, the commodity tug of war, and finally, the future of crypto.
All right, part 1, the global macro picture, the rock hitting the water.
Okay, so to understand any specific market movement right now, we really have to zoom out and look at the overarching macroeconomic climate. Think of this climate like a giant rock hitting a calm pond. And right now, that rock is pure fear. What we're seeing is this massive market-wide risk-off sentiment. Investors are seriously spooked by the escalating conflict in the Middle East, and it's triggering a huge flight of capital out of riskier bets and straight into safe haven assets. But here's the crazy part. The core conflict of our current economy, it's a massive tug of war. On one side, everybody wants the safety of the US dollar. But on the exact opposite side, this geopolitical conflict is driving up oil prices. And that brings the terrifying threat of a brand new inflation cycle, literally just as we all thought US inflation was finally cooling down. This tension right here is absolutely crucial to understanding all the ripples spreading outward through the market. Let's look at that first ripple. Part 2, pressure on equities, the tech route. You can literally see this deep market instability when you look at the NASDAQ 100 and the S&P 500. The hangover from the recent selling pressure is just bleeding heavily into this week. I mean, we've got the S&P 500 dropping over 1% and the tech-heavy NASDAQ sinking nearly 1.7%. This isn't just your standard market dip, It's a fundamental shift. Investors are starting to seriously doubt big tech, and they're pulling their money off the table to find safer places to park it. And honestly, nowhere is that doubt more obvious than right here. 20%. That is how much the Philadelphia Semiconductor Index, or the SOX, has just completely evaporated since its peak back in late June. Just last week alone, it dropped over 10%. So what does this actually mean? Well, this is the market aggressively questioning the entire AI boom. Investors are suddenly looking at these massive, sky-high tech valuations and asking themselves, wait, is the actual real-world demand for AI sustainable enough to justify these crazy price tags? Now, what makes this equity sell-off so fascinating is the weird paradox in the data. Look at the current Q2 earnings season. An absolutely incredible 90% of S&P 500 companies that have reported so far have actually beaten expectations. So on paper, businesses are doing fantastic, but investor sentiment remains highly cautious, honestly even fearful. Why is that? Well, because solid earnings just don't mean much if a geopolitical crisis suddenly triggers a new wave of inflation, right? Investors are actually warning of even deeper corrections in the tech sector because of all these geopolitical risks. Because of that, everyone is going to be watching the upcoming earnings reports from Tesla, Alphabet, and Intel with a magnifying glass. Moving on to part 3, forex hotspots, currency dominance. And this brilliantly illustrates how the flight to safety is playing out in the currency markets. The IC US dollar index, or DXY, is trading really strongly right around 100.9 points. Now, normally, with US inflation data showing signs of cooling off, you'd totally expect the Federal Reserve to hint at rate cuts, and that would usually weaken the dollar. But the dollar is remaining incredibly stubborn and dominant right now. Why? Well, because when missiles are flying and the Middle East is unstable, the whole world just wants US dollars. It is the ultimate safe haven asset, and right now, it is completely overpowering that whole cooling inflation narrative. But this super strong dollar, it's creating pure chaos elsewhere, especially in Japan. We're looking at a massive spike in the USD to JPY pair, which is trading at a crazy high 162.5. And this is being driven by a massive chasm between central banks. On one side, you have the US Federal Reserve keeping yields high. On the other, the Bank of Japan is widely expected to just keep their rates at rock bottom at their upcoming July meeting. Because of this, the yen is just getting crushed. And to put that into perspective for you, this is exactly why importing energy just got exponentially more expensive for Japan. Think about it. They have to buy oil, which is priced in those expensive dollars, using their severely weakened yen. That brings us to part 4, the commodity tug of war. Now, over in the physical markets, commodities are behaving like tightly coiled springs right now. We recently saw Brent crude cross $90 a barrel and WTI hit $84, all driven by massive fears of a supply disruption through the Strait of Hormuz. Though, to be fair, it did face some heavy sell-offs shortly after that. But at the exact same time, gold is recovering from a recent dip and is currently testing a massive psychological barrier at $4,000 per ounce. Both of these assets are just reacting violently to literally every single news headline coming out of the Middle East. So the crucial point here is understanding the incredibly complex relationship, that ultimate tug of war between these two assets. You see, gold usually thrives during wartime because it's your classic safe haven. However, if that war causes oil prices to spike, well, that brings inflation. And if inflation rises, the Federal Reserve is pretty much forced to keep interest rates high. Those high interest rates boost the US dollar, which then makes non-yielding assets like gold much less attractive to hold. So gold is literally caught in the crossfire of its own safe haven appeal versus the macroeconomic fallout of super expensive oil. All right, let's wrap things up with part 5, the future of crypto, a reality check. Let's see how digital assets are reacting to all these macro ripples. Right now, Bitcoin is hovering around the $65,400 mark, but let me tell you, the price action has been sheer violence. Despite a slight recovery over the past week, a lot of technical indicators are flashing serious warning signs. The market movements over the last 24 hours have been characterized by intense, highly emotional swings. We're talking massive pumps and dumps that have completely wiped out over-leveraged traders. It is an incredibly dangerous environment for short-term speculation right now, for sure. And when we actually look under the hood, we're seeing multiple bearish signals. The crypto fear and greed index is sitting at a dismal 26, which pretty much screams pure market fear. Plus, we're seeing stablecoin reserves on major exchanges like Binance dropping, which tells us that buying power and overall liquidity are just drying up. We also really need to myth bust this whole idea of Bitcoin as digital gold right here and now. Unlike physical gold, Bitcoin is absolutely not benefiting from these geopolitical war tensions. Actually, it's being heavily weighed down by expectations around liquidity and interest rates. Interestingly, though, we are seeing Ethereum actually outperforming Bitcoin in the short term, which kind of hints at an internal rotation of capital. Going forward, the whole market is going to have its eyes glued to regulatory developments like the Genius Act for stablecoins and corporate treasury moves by major players like MicroStrategy.
Which brings us to our final thought for today. OPEC actually just downgraded its global oil demand forecast for 2026 for the third consecutive month, and that's all due to broader economic headwinds. And yet, prices are still spiking because of these immediate war fears. So I want to leave you with this lingering question. Will the short-term, violent supply risks coming out of the Middle East ultimately overpower the looming longer-term threat of a global economic slowdown? The answer to that question is almost certainly going to dictate the direction of your portfolio for the rest of the year. Keep learning, keep analyzing, and we'll see you in the next explainer.